thank you for joining us. My name is Adam O'Day, and I'm the business lead of Private Wealth. We are meeting virtually, wherever you may be, your home or your office. I begin today by acknowledging custodians of those things we are meeting. Respects to our morning. Private Wealth is delighted to bring you this markets investment seminar. We're wanting to address a number of the key questions. On the years, consider what the year ahead might bring. This morning, I'm joined by my colleagues, Sally Hall, Chief Investment Officer, Jb Weir, Dion Kavanagh, Wealth Advisor, also with Jb Weir, and Gilbiamo, Regional Director, Private Wealth Solutions. Thank you for those that have already passed on questions during the presentation. If you do have a question, please pop it into the Q&A box and we'll endeavour to answer them at the end of the presentation. So it's been a really interesting 24 months. And I acknowledge some of the news that's coming out of Europe today, but we're seeing economies and communities opening up. We're reading and hearing commentary and opinions around inflation. Is it long-term, sustainable, transitory? Labour markets, wage growth, asset valuations, challenges with global supply chain, central banks and interest rates, just to name a few. So this morning we're delighted to have Sally Hall, Chief Investment Officer with Jb Weir, leading our discussion today. Sally will provide her views on the macroeconomic backdrop and focus on a couple of themes, being what's likely to change in 2022 versus 21, what that might mean for investment markets, and key risks to the markets and outlook. And with that, Sally, I'll hand over to you. Thank you.
Thanks very much, Adam, and good morning, everyone. Thank you for your time today. As Adam said, it's a really fascinating time to get together and talk about the outlook for 2022. We've seen a number of central banks start to talk a bit more constructively about the outlook for higher interest rates over the year ahead. We've had a surge in energy prices, which all of us are feeling at the petrol pump when we go to fill up our cars. And as Adam mentioned, there's a lot of talk around inflation and whether we're in some sort of stagflationary environment. And yet when we look at markets, equity markets, most of them at least, are pretty close, if not at all-time highs. So as Adam said, the three things I'd like to talk to you about today, just to the next slide, please, Brent, are, what will be different in the year ahead versus 2021, what that might mean for investment markets, and then we'll talk about some of the risks that we see to the outlook in the year ahead. And I'm hoping at the end of all of that to really provide you with a sense of what the macroeconomic and investment outlook might hold for the year ahead. If we could just go to the next slide, please, Brent. I think there are two things that I think will be quite different next year relative to what we've seen in 2021. And the first of those is really the policy outlook. And when we talk about policy, we're talking about particularly monetary policy, but also fiscal policy as well. And you can see from the chart there on the left-hand side of the slide that in most major economies, whether that's the UK, the US, Canada, and the Euro area, market expectations are that policy rates will start to lift over the course of 2022. Now, in some countries, such as the US and Canada, that rise in rates looks reasonably aggressive. And I guess the question is really whether central banks will deliver as much as the market has priced in. But I think the key point is that we are past the peak dovishness of central banks. And next year will bring a change in the monetary policy environment where central banks, most of them, including our own in Australia, will complete what they call the taper of their quantitative easing purchases. So they're the regular purchases of bonds that central banks have been making each week since the pandemic started in March of last year. And also in some cases, we will see short-term interest rates or policy rates start to rise. So the monetary policy environment will become less accommodative and therefore less supportive for economic growth. The other thing that's going on which is I think very important as well, is fiscal policy. And so we all recall that governments, through the course of 2020 and some governments in 2021 delivered very stimulatory fiscal policies. So they did basically whatever they could to support households and to support businesses through an unprecedented period in the global economy. And the chart that you can see on the right of this slide basically is an estimate of how much fiscal policy has contributed to GDP growth by region. So the dark blue bars are for the US, the light blue bars for the other parts of the developed economies and so on. And you can see the huge spike in that series through 2020 as governments really delivered fiscal largesse. What is going to happen as we move through the back end of 2021 and into 2022 is that the impact that fiscal policy has on global GDP growth will actually start to reverse and on net become a drag for growth. And that's particularly the case in the US, understandably in the sense that they had the biggest sort of stimulus from fiscal policy. They'll also get the biggest drag in the year ahead. And so I think that the really key point on this slide and thinking about 2022 is that the policy backdrop will change quite significantly over the course of next year. And what's effectively happening is that we are trying to transition the economies that have had significant support through the pandemic off that support and into a more sort of self-sustaining trajectory. History tells us that when you try and deliver those transitions, they don't always go smoothly. And I think it's probably fair to say that this is, for me, one of the most significant differences when we look ahead to 2022 versus 2021. The other difference, and if we could just go to the next slide, please, Brent, is really about the macroeconomic outlook. And so the chart on the left, is really all about this stagflation narrative. And what it shows is two lines which basically represent what we call forecast revision indices. So what we're really looking at is how the forecasts for global inflation and global GDP growth have changed over the last little while. And you can see very clearly from that chart that forecasts for global GDP growth have come down a fair bit. And at the same time, forecasts for global inflation have lifted. And this is why there has been a fair bit of narrative around whether we're in some sort of stagflationary environment with low growth and high inflation. My sense is that that's actually not the right way to look at the current environment. And partly because, a stagflationary environment is generally one where unemployment rates are actually going up. And in most economies, if you look at trajectory of unemployment rates over the last sort of 6 to 12 months, they've been very clearly down. So I'm not really a big buyer of the stagflation narrative, and I don't think it's something that we have to worry about as we approach 2022. If we look at the chart on the right, it really just sort of reflects what we've already talked about. This is a chart that just shows when we look at all the countries out there and we look at the percentage of all those countries that have had their growth forecasts upgraded or lifted in the past 3 months, you can see that series is sort of hanging around sort of 20 to 30%. So again, consistent with this idea that, as we've moved through the back half of 2021, growth has disappointed in most jurisdictions relative to expectations, and economists and forecasters have been forced to take out the red pen and mark down their global growth forecasts in aggregate. If we can just move to the next slide, my sense going forward into 2022 is I think those two narratives of higher inflation, lower growth will actually start to reverse. And we're really starting to see just in the past week some really encouraging signs out of the US in particular, also the UK, that some of this disappointment on growth is now starting to fade. Data is starting to print on the stronger side of expectations, which if we can continue that into year end should set us up for a pretty good growth outlook in 2022. So the chart on the left here just shows what the consensus expectation is for GDP growth. That's the light blue bars. And so you can see a big pickup in this quarter versus the third quarter and some pretty solid numbers, at least in the first half of 2022. Probably most importantly, what that chart also shows is expectations for the US unemployment rate. And that's the pink line on the chart. And the most important thing is that you can see that that line continues to trend lower over the course of next year and into 2023. And so effectively what that chart is telling you is that, while growth rates next year might not be as strong as they were in the first half of 2021, they will nonetheless still be strong enough to force unemployment rates lower. And that, is generally seen as a pretty good indicator of strong economic growth. The same also applies for Australia. So if we were to do the same chart for Australia, we'd see a pretty awful outcome for third quarter because of lockdowns. but a really decent rebound in the fourth quarter, and also a line that shows a falling unemployment rate through the course of next year. Interestingly, inflation, which has been so topical, you can see on the chart on the right there what's happened. We've had this huge lift in inflation. We sort of started 2021 with inflation rates around sort of 1.5%, 2%. And then as we've moved through the year, we've seen some very big jumps in inflation, I think driven really by a perfect storm of a number of factors. First thing was some very funny changes in prices as economies reopen. So, for example, the price of used cars has jumped a lot. Then we basically hit the supply chain issue, where we know in an environment where goods demand has been super strong through the course of this year, basically supply chains were compromised, and so we saw quite a sharp lift in goods prices. And then the final sort of factor driving inflation higher of late has just been what's happened to energy prices, oil prices in particular. But what's interesting about that chart is when we look forward into 2022 and into 2023, the consensus expectation is that a lot of those effects will start to fade as we move through the year. And the consensus is basically saying that by the time that we get to the end of next year, both core or underlying inflation and headline inflation should be sitting somewhere between 2 and 2.5%, which is a far more palatable outcome for central banks and markets than inflation rates at the moment, which are sort of closer to 5.5%, 6% on the headline measure. So my sense is that the other big change for next year will just be a shift in that macro narrative, where we start to get more constructive on growth and we start to worry less about inflation. So Brent, if we could just go to the next slide. What I wanted to do was just talk a little bit about what this all might mean for markets and how we're seeing the outlook into 2022. And I think it's important, before we talk about the outlook, just to sort of get a sense of where we are at the moment. And what this chart does is it looks at a whole range of markets and sectors. So you can see on the left of the chart, we've got a variety of equity indices. Then we look at it, particularly the S&P by sector, so financials, industrials, energies, etc. Then we have a whole block of currencies, we have a block of commodities, we have a block of 10-year nominal yields, and then finally we have some credit markets. And basically what this chart does is it tries to take a big picture cross-asset view of markets and look at which markets in which parts of the world look expensive and which look cheap. And the way we do that is just to look at valuations across markets and ask ourselves this question: how many standard deviations are you away from your 15-year or long-run average? And basically, if you're at 2 standard deviations above or below, then you're either very expensive or very cheap. And what we observe when we look at that chart is that some markets and some sectors are expensive, and these are the ones that you would probably expect if you follow markets closely. So particularly the tech sector, so the NASDAQ, but not that many are cheap. And in fact, if we look at the cheap markets, they all tend to be concentrated in a particular part of the world, which is the emerging markets complex. So if we look at equity markets, the only one that really trades on the cheap side is Latin American equities. If we look at currencies, the only really cheap currencies are, again, emerging markets, so Turkey, Russia, Mexico, and similarly in the fixed income space, it's really only Mexican 10-year yields that screen a little bit cheap on our chart. So I think this is a really interesting sort of point just to observe that there's not a lot of cheapness out there in the market, and there are, in fact, quite a few sectors and markets that are screening expensive. And I think this is an important point, just simply because if we're moving into a world where central banks are effectively withdrawing liquidity from the system, then my sense would be that it's really the expensive markets that look most vulnerable to some sort of a correction as that liquidity withdrawal occurs. Brent, if we could just go on to the next slide, please. I think one of the things to sort of understand is, why are markets looking a little bit expensive at the moment? Well, if we look at the chart on the left, one of the reasons for that is simply because across a lot of markets, returns have been well above longer run averages. And so what this chart does here is it just looks at the purple diamonds on the chart, which just show what are the rolling 12 months returns that you've been able to get from all these markets. So you'll see, again, on the left, a lot of equity markets, they are running well above their 15-year, 12-month return average. Similar sort of story for commodities, particularly Brent, which has done very, very well. And then elsewhere in currencies and also fixed income, returns are about average. And so one of the reasons I think, markets do look on the more expensive sides is simply because we've had such a stellar run, particularly in those growth assets like equities and commodities. So what does that all mean for 2022? Well, I think that the first important point is that, at Jb Weir, our expectation is that returns should moderate as we move through 2022. And the chart here on the right just really shows you two things. So the light blue line is the Global Manufacturing Purchasing Managers Index, which is effectively a really useful series that shows us in one series the cyclical ups and downs of the global economy. And when that light blue line is below 50, basically means that global manufacturing is contracting and we're in recession. When it's above 50, it means that global manufacturing is expanding. The dark blue line really just shows the excess returns that you get from holding Australian equities versus Australian government bonds. So that tends to move with the cycle as well. So when the global economy is doing really well, we're typically in a period where equities outperform government bonds, or growth assets outperform defensive assets. But what you can see over the last 20 years of history with that chart is that the two things move together. And as the global macroeconomic cycle starts to transition away from the recovery phase, which we've just been in, into what we would call the mid-cycle phase, typically those returns that growth assets or equities give you relative to defensive assets start to moderate as well. They still remain positive, but just not as positive as they are through that recovery phase. So I think, returns will moderate next year, and that's partly a function of where we are in the macro cycle as per that chart. It's also a function of the fact that, as we talked about at the beginning, the settings of both monetary and fiscal policy will become less accommodative, and that will make, I think, the trading environment for markets a little bit more difficult than it has been in the last 18 months. And I think there's also a case of, we've actually brought forward some of the returns through the cycle in the last sort of 12 to 18 months. Returns have been, so strong and so well above longer run averages that there's a sense that we have probably brought some of those forward. So for those reasons, we do think returns should probably look a little less exciting than they have over the past 12 months. What does that mean from a portfolio perspective? It means a couple of things. The first point would be that you don't, in our view, at this point, need to do anything from a strategic asset allocation perspective. So we're still comfortable to run portfolios that are overweight growth assets versus defensives and earn the risk premium that's still there in some of those asset classes. The second thing is that, we think it's really important, particularly at this point in the macro cycle, to run portfolios that are diversified. So rather than just hold a lot of equity risk, we like adding what we would call real assets to the portfolio, so things like property and infrastructure. We also like owning a small allocation to what we would call uncorrelated assets, so things that don't always move up and down with the cycle. And then the third point, and the last one that I would make, is just simply that now is probably a really good time to be looking at your portfolios at an asset class level and just really trying to identify, where you think, you might have some riskier exposures that might be a little bit more vulnerable as we move into, what could be a slightly more difficult trading environment for markets. So in the case of equities, we're really recommending to our clients at Jb Weir that they start to really focus on the companies that we would describe as quality stocks. So, balance sheets that aren't over leveraged, profit margins that look reasonably resilient to potentially a more difficult environment. So, Brent, if we could just go to the next slide and just to really sort of conclude, the main points really for the year ahead is that the policy backdrop should be quite different next year compared to 2021. Macroeconomic conditions should actually become a little bit more favourable, so we should get higher growth and a moderation in inflation. It's a problem in a sense that markets enter this year with reasonably elevated valuations, and that's partly a function of the fact that they've delivered super strong returns. And we are very mindful that there are pockets of markets that look expensive, whether that's at a stock level or a sector level. that could be a little bit vulnerable to higher rates and liquidity withdrawal. We still think growth assets are likely to outperform defensive assets. And in terms of the risk that we think about next year, inflation remains a really big one. If we're wrong on this view that inflation should moderate over the course of 2022, then that will have very important implications for the way central banks behave, and the way multi-asset portfolios will also behave. Real yields is another thing that we worry about. They are incredibly negative at the moment. And so if real yields were to correct higher, then that would potentially be, I think, a significant headwind to equity markets. And then the final risk we worry about is just simply the risk of a policy mistake. So, if we bring that back home to Australia, we know that the RBA is sitting there telling us that they're not lifting rates next year. They possibly think they won't lift rates in 2023. And they actually believe that based on their current set of forecasts, they won't lift rates until sometime in 2024. This is all predicated on a view that inflation will take a number of years to lift, that wages growth won't reach 3% until the end of 2023. And I guess, given some of the stuff that we're observing in the labour market at the moment, one thing that does sort of, keep me awake at night sometimes is the risk that, central banks who are taking a far less preemptive and a far more reactive approach might find themselves in the midst of a policy mistake. And we know that when those happen, that's never usually a fun environment for markets either. So on that note, I'll finish there, hand back to Adam, and look forward to take any questions you might have in our panel discussion. Thanks, Adam.
Thank you, Sally. A lot of insights there for all of us to consider. And how does an investor position themselves going forward? So to assist with that thinking, our next speaker is Dion Kavara. He's a wealth advisor with Jb Weir. And Dion will be sharing insights into Jb Weir's approach in providing wealth and investment advice to our clients, as well as some commentary on asset allocation, portfolio positioning, and investment opportunities that have been of particular interest to clients. Thanks, Dion.
Good morning, everyone, and thank you, Adam, for the introduction, and for Sally for your comments. Always insightful. As Adam mentioned, I'm an investment advisor with Jb Weir, and I work closely with NAB's private bankers in meeting the complex wealth and investment needs of a very diverse client base. Today, I'll address three key areas. So the first is around Jb Weir's approach to asset allocation. Secondly, around the investment themes that are top of mind for clients, and Sally certainly touched on a few of these. And thirdly, the investment opportunities we do see in a market that many fear is expensive. Before I go on, I might just give you a little bit of background on Jb Weir and what we do for those that are unaware. So Jb Weir is a wealth management business that was founded in 1840 and is 100% owned by the National Australia Bank. And our mission is to strengthen the financial standing of our clients through bespoke wealth and investment strategies. As you can see on this slide, there are four key pillars to our offering. So the first is around wealth advice, where we assist our clients with their entity structuring, superannuation, retirement planning, estate planning, and intergenerational wealth transfers. Secondly is around investment advice, where we provide our clients with comprehensive advice on asset allocation, investment selection, portfolio construction, and the ongoing management of investments. Thirdly, philanthropic advice. So we have a number of clients, both families and for-purpose organisations, who are managing their wealth to achieve social good. And finally, family advisory, where we work with families to develop their governance systems to ensure wealth is preserved and grown over time, and certainly for the next generation. We'll just move to the next slide, please, Brent. So I want to spend some time talking about our approach to asset allocation and portfolio construction. So we recognise that every client is different. We all have different risk profiles and investment preferences, and so no two portfolios are ever the same. And so we spend a lot of time with our clients to understand what's truly important to them before we invest a single dollar. Our starting point for building multi-asset portfolios is around strategic asset allocation. So this process is really around finding the optimal allocation of capital across a range of asset classes, given a client's particular risk and return preferences. However, the lion's share of portfolio performance really can be attributed to the asset allocation decisions we make rather than the underlying individual investments. And I think that's a really important key. In explaining some of the asset classes on this page, I might do so by actually referring to some of the conversations we're having with clients at the moment and how we are using combinations of asset classes to navigate the investment markets that we're in at the moment. So one of the key conversations is around the low interest rate environment. It has been a conversation for a number of years now. And when we look at the rate of return on cash, it's really encouraged clients to pivot their investment strategy away from traditional term deposits that once upon a time did pay 4 and 5% to look at a number of other asset classes. So one strategy investors have looked at in recent times is the credit asset allocation. And really this is around the corporate bond market. As a credit or corporate bond investor, this involves lending capital to large blue chip companies for a fixed period of time for regular interest payments. These corporate bonds are liquid and tradable, meaning they can be bought and sold before maturity, and the returns are generally in the range of 2 to 3% in the current environment. However, we're seeing most clients actually use a combination of these asset classes rather than just choose sort of one or the other. The second theme pervasive in conversations with clients, and as Sally's mentioned, inflation and negative real yields. And so if we think about the last 18 months, whether it's been property, equities, cars, or even a cup of coffee, it feels like the price of just about everything is increasing. And most of this can be attributed to low interest rates and very accommodative fiscal and monetary policy. So in short, there's a lot more money circulating in the economy than there was before. And so finite resources are obviously, or finite goods and services are increasing in price. So with cash generating almost 0%, the risk of inflation encourages us to be invested more than not. However, there are some assets that will perform better in an inflationary environment than others. And I'd like to talk about a few, and obviously drawing on some of the asset classes that we see on the page here. So real assets, which includes real estate and infrastructure investments, these assets have offered strong returns to investors over a long period of time. And these assets generally have inflation-linked revenue, which protects their earnings potential moving forward. These include things like roads, toll roads, airports, gas pipelines, and the like. Moving on to equities, still we see the greatest source of returns derived from equity markets. I'm thinking about the Australian market, which is very well known to Australian investors. It is narrow by composition, with a strong weighting towards financials and the mining sector. Whilst global equity markets gives us the opportunity to invest in the very best businesses, irrespective of where their jurisdiction is, across key growth sectors, which are often underrepresented in the Australian market, being technology, healthcare, and a number of consumer brands. We feel that equities should do well in an inflationary environment, assuming, as Sally did mention, they are high quality businesses with monopoly characteristics that have solid margins and an ability to protect those margins through the cycle. And lastly, I might just touch on the uncorrelated asset, which you can see sort of on the top of the chart there. This asset class includes things such as gold and hedge funds. And so touching on gold, it does feature in portfolios. It does provide an inflation hedge given its limited supply and universal store of value. The third conversation we are having with clients at the moment, and again, it was touched on earlier around a number of very expensive asset markets, is it too late to invest? How do I go about investing today? And we all go through different points of different examples of liquidity events, whether it's selling a business or selling an asset or inheriting money. And so sometimes the market isn't the perfect time to invest, but I think there's always the opportunity to put money to work. And so whilst we expect the easy gains are behind us, we still continue to expect that growth assets will outperform defensive assets in the coming quarters. But risk management is increasingly important as we move forward. As we know, the future is inherently unknown, and we've experienced that firsthand over the last couple of years. And therefore, we adopt a number of strategies as we invest to protect our clients' capital. We diversify portfolios. We seek high quality investments with strong track record over a long period of time and through the cycle. We perform deep due diligence before making an investment, and we continue to monitor those investments over time. We stagger portfolio investments, so we're not going to be investing all capital on day one. We stagger the investment so that we can dollar cost average our way into markets and also take advantage of opportunities as they present. We seek uncorrelated assets where their return profiles a little bit divergent to, say, equity markets. And we look to adopt unlisted assets and private assets as well as listed public assets. And we always ensure there's enough cash in portfolios so that we can meet our expenses without ever being in a position where we need to sell or be a forced seller. We'll just move on to the third slide, please, Brent. I want to spend some time discussing some of the particular, or some investments of particular interest to clients. While equity and bond investments continue to make up a large part of portfolios, there are a number of compelling opportunities we see in the market at the moment. The investment strategy group at Jb Weir, led by Sally Auld, conducts significant due diligence and extensive research on all the investments that we put in front of our clients. So within the credit sleeve, aside from corporate bonds and ASX-listed hybrids, which are familiar to many, we also invest in private debt. So this allows investors to lend small or high growth businesses in exchange for a significantly higher rate of return. And the returns might be in the range of sort of 5 to 6%. So yes, there is more risk, but we've seen actually fairly low rates of volatility in that space. Within real assets, we've brought a range of opportunities to clients over the last 18 months, both public and private, but also domestic and offshore. But some examples include Stonepeak Infrastructure Fund, which is a North American focused unlisted infrastructure fund. So using a manager who is well versed in that part of the world, investing in good defensive infrastructure assets, and also fund Palisade Infrastructure Fund, which was an Australian-focused mid-market infrastructure fund. Returns in the range of 8 to 12% is the expectation there. And if you're thinking about it, we're actually investing in very long-term monopoly defensive assets, which is what we like to see in this environment. Again, within real assets, we've seen a lot of interest for impact investments. So these are investments that have both an environmental and societal benefit, but also financial return. So an example is an impact investment fund, and the fund actually invests in things like social housing, disability housing, and solar panels. And so whilst we might think about equities sort of be up or stronger or weaker next year, there are actually investment classes that will perform well irrespective of what equity markets do. Another example is a net zero carbon transition fund, where we can actually leverage that global shift to achieving net zero carbon emissions, which we think is arguably one of the greatest commercial opportunities of our time. Just within international equities, there are two sub-asset classes which are on the chart in front of you here. One being private equity. So this allows us the opportunity to invest in high growth unlisted private businesses where we expect returns should outperform listed equity markets over the long term with limited volatility. And also emerging market equities where we do see significant value, doesn't come without risk, but we can leverage the faster growing economies, whether it be China, India, Russia and the like. And finally, within uncorrelated strategies, we are looking for, say, things like hedge funds where they can actually make money where the markets go up or down. And this again provides portfolios with a differentiated source of returns for their portfolios. I might leave it there. I hope I've given you at least a few things to think about in light of your own investment strategy. We'll welcome any questions during the rest of the presentation, certainly after via your private banker. And with that, I'll pass back to Adam. Thank you.
Thanks, Leon. diversification, multi-asset portfolios, the quality of assets, timing of when you enter the market, and also a growing curiosity with our clients with impact investing, all things to consider and have conversations with a trusted advisor. Our next and final speaker, Paul Gilbiamo, is our Regional Director, Private Wealth Solutions, and Paul and his team support our self-directed client base. And Paul's here today to discuss the themes that they're seeing with that particular market segment, as well as touch on some of the opportunities that private wealth brings to that client base to complement their individual wealth strategies. Thanks, Paul.
Thank you, Adam, and good morning, everyone. And thanks also to Sally and Dion for their very informative presentations, which I'll actually use a little bit of in my presentation here. So as Adam mentioned, Private Wealth Solutions is a group of investment and market specialists that are born essentially out of the old markets business, where the role was predominantly around foreign exchange risk management and also interest rate risk management, and then some sort of yield enhancing products. And has then obviously gone through several iterations in my time at the bank, which is roughly 19 years, and has now become what you see on the screen in front of you today, which is quite a comprehensive list of different opportunities for investors around that wheel there. So we deal purely with wholesale and sophisticated clients only. So that typically means as a minimum standing, you're looking at net assets of $2.5 million or more, or gross income over the past 2 tax years of $250,000 per year. So that's typically your minimum qualification to become a wholesale client. And once a client is classified as a wholesale client, we'll deal with that client, but purely on a general advice basis. So obviously, Dion articulated the Jb Weir proposition very well there. That's our advice offering. So the Jb Weir guys do a fantastic job on that front. But for clients that are self-directed and would like to make some of their own investment decisions, then we're able to assist on that front. So we provide, as I said, a range of different investment and risk management solutions on that general advice basis, where we can have conversations with our clients around risks, features, and benefits of any of the things that we discuss. And then ultimately the client makes their own decision as to whether they would like to participate in that particular transaction. So with that said, I'll go around the wheel a little bit here and touch on a few of the points in the areas that we do cover. So I might start in the top left-hand quadrant and then, well, not quadrant, but I'll work my way around that wheel. So again, dedicated investment team. There is a group of 7 of us in Melbourne that can assist with clients in the south. We will have 2 people over in Perth as well, and we also service South Australia in that south part of the business. We're here for face-to-face meetings, for coffees, catch-ups, phone calls, whatever it may be, to make you feel comfortable, to talk about markets, talk about what's happening, talk about individual products, and go into more detail with you. And again, we've also got the backing of obviously the bank's research team. Now that the equity research piece is purely sitting inside Jb Weir, but we also have a little bit of research in our NAB trade platform, but we also work with the NAB markets research team across foreign exchange rates and credit research as well. Risk management, as I mentioned, was one of the sort of core pieces of our business and has been for a very, very long time. And currency risk management and interest rate risk management on commercial lending has been a very important part for our clients over the long term. But the bank also is the only major bank that has an over-the-counter equity derivatives business. So what that essentially means is that we can provide bespoke equity risk management solutions for our clients as well. Now, I guess leveraging off the presentation of Sally and again what Dion discussed as well there's an obvious sentiment that equity markets are overvalued in some way, shape or form. So the equity risk management business can really come in handy here, again, providing those bespoke solutions to protect your equity portfolios. And it's something that a lot of investors don't necessarily think about. You insure your house, you insure your car, you insure your life and your income, and clients have very, very large equity portfolios sitting there with typically no protection whatsoever. So again, equity risk management is quite a common topic of conversation for my guys at the moment. Just having a conversation around what sort of solutions the bank can put in place to actually protect from any significant equity market downside. In terms of investment lending, obviously our business also encapsulates the margin lending business as well. So we have margin lending specialists there to assist on that front. And we also have Equity Builder and Super Lever, which provide investors with the opportunity to lend within their super funds as well. Then we do a lot in terms of unlisted investments. And so with the bank, we obviously have our primary issuance business, which deals a lot in the listed side in particular. So your listed investment trusts, your hybrid products as well. We do a few equity IPOs also. And so you'll see those opportunities come out via the wholesale investor register from time to time. The unlisted investments can also come in a primary form. So we do a lot in the corporate bond market. So NAB is actually the #1 distributor, provider and originator of corporate bond or corporate fixed income product in Australia. And so we do a lot of that in-house. We're also involved in many, many large corporate bond transactions that we're able to show to our clients. But we also work in these other sectors as well. And so we do a lot in property, whether it be listed or unlisted property. We do a little bit in private equity as well, which I'll touch on a little bit later. And then we have some unlisted yield enhancing products that can be linked back to both equity markets and currency markets that have been particularly popular through the last sort of year and a half, particularly around COVID, that feed off the volatility in the market. So they're ways that clients can actually use that enhanced volatility that you see in the markets at times to actually enhance the yield on your cash when your term deposits are returning you sub 0.5% yield. So some really interesting bespoke opportunities there. On the listed front, again, as I mentioned, you'll see IPO come through that wholesale investor register. Basically, every single hybrid opportunity we are typically on, unless there is some sort of political stoush between some of the treasuries of the major banks. But we are typically on a lot of those and can provide allocations to our wholesale investor clients in that space. And then again, we do some long-short equity funds as well. So we did the Regal funds quite recently, which has done very well, excuse me. We did the L1 long short fund that no doubt launched at a very difficult time for a value investor when growth markets were going gangbusters, and they did definitely struggle. But as Sally and Dion have spoken about, what we're seeing now is an environment where those sort of really solid, strong balance sheet companies are performing very, very well and very much so outperforming those growth companies. And L1 has performed significantly better than the market during this period. So again, we provide opportunities in that space as well. And then of course, we also work very, very closely with NAB Trade, being our online equities trading platform. And with that said, I should also mention that today is the charity trading day. So 100% of the brokerage is going to charities today for any deals done on NAB Trade. So 80% of that will go to UNICEF's Give the World a Shot campaign to help deliver COVID-19 vaccines around the world. And the other 20% will also go to the ASX Refinitiv Charity Foundation. So if you are looking to make a trade, try and do it today. And obviously a lot of that brokerage, or all of that brokerage, will go to charity. So with that, Brent, I might move on to the next slide. And I just want to touch on a couple of investment opportunities that are very, very different, but they also provide a little bit of a flavor of some of the different primary issuance opportunities that we can offer our investors. So the first one here is the AAM Diversified Agriculture Fund, which is a private equity opportunity. Now, this is very, very different to the majority of things that we do. So again, we do a lot in the fixed income markets. We do a lot in ASX listed primary property, etc. Private equity, though, is something very, very different for the bank. And the bank is very, very conservative in terms of what they will show to clients. About 85% of the deals that are brought to the bank's team typically get knocked back. So for NAB to put their stamp on a deal, they have to go through a very strict due diligence process. It has to pass through a wholesale investor committee, and only then will clients actually get a chance to invest. So AAM are a group that the bank's been working with for about 5 years. I've got an intimate relationship with the group there. The bank is very comfortable with the balance sheet and the actual business itself. And so AAM over the past 2 years have actually launched the Diversified Agriculture Fund. And what this seeks to do is bring together a range of different assets from around the country, different sorts of diversified agriculture projects. So you've got an example in the below right-hand corner there. So you've got the Southern Cross Poultry Fund, which essentially raises chickens and sort of houses them, feeds them in a free-range environment. You've got the Sunshine Farms aggregation, which is involved in cropping, grain. You've got sheep and some beef cattle on that property as well. Australian Livestock Company, which again is predominantly beef cattle. You've got a lot of water licenses there as well. And then the Australian Softwood Company, which provides a nice steady stream of income in this particular fund. So you've got sort of a nice cross there of some capital, I guess, improvements and capital increasing sort of investments, but you've also got some really nice yield investments in there. The Softwood Company, as an example, yielding sort of double digits a year, excuse me, that basically provide a really nice cross section of different sorts of agri assets around the country. And what AAM have done with this particular fund is they've set themselves a target of over the 7-year period from start to finish, of which we're roughly 2 years through. They're looking to raise about $850 million and basically build that asset group up to about $850 million value, and then look at a potential exit for clients, which may involve listing on the market, it may involve trade sales, etc. But over the course of time, this fund is essentially looking to target a return of around 12% per annum. And that's typically made up 50-50 of income that's paid back to clients quarterly. So every 90 days, clients receive a distribution. And then you've obviously got the capital uplift there, which is expected to be or targeted to be around 6%. The fact of the matter, the fund's performed extraordinarily well and well above those expectations. And so last year it returned about an 18.6% internal rate of return. But again, the thing that we really, really like about this sort of investment, and that our clients, I should say, more like it, is that it's completely diversified and non-correlated to the traditional investments that they have in their portfolios, being predominantly cash, property, equities, and maybe some fixed income. So agriculture is obviously a very difficult sector to access. AAM do a fantastic job of it. We really like the way that they're geographically diversified, as well as diversified in terms of the different sorts of streams that they have within the fund. And look, this is an opportunity that typically comes about every 6 months. As AAM find different projects around the country, they will look to raise funds to add that project into the overall diversified fund. So again, we're about 2 years down the track in this particular one, but being on that wholesale investor register enables you to have access to something like this. And it's a really interesting opportunity and something very, very different to the majority of investments that we do offer. And so Brent, if we go to the next slide, I'll give you another example of something that's probably more in line with the sort of deals that our clients see from us. And that's something that's more based around fairly capital stable investments that just provide a really solid stream of income. And obviously that's been very, very important in a market where term deposits have come off to levels, as I mentioned earlier, that are sort of sub 0.5%, and clients are looking at different means of increasing the yield on their portfolios. Now, Qualitas is a name that a lot of you may know. Qualitas has been around since about 2008. They've loaned about $10 billion out to the market, and they're a significant player in that huge growth market of alternative providers of capital in Australia. So alongside companies like your Wingates, your CVS Lanes, MaxHap, etc. And this is a fairly immature business in Australia, immature market, I should say, where in Australia, you've probably got 85% of the lending done by banks, and then 5% by money markets, and about 10% by these alternative providers, where if you look at, say, the US and Europe, then about 40% of the provision of lending over there typically comes from these sorts of providers. So again, much more mature market overseas. But Qualitas is a fairly strong business that, again, has been able to deliver really good returns for clients in a fairly safe way. Now, again, there is always added risk, and Dion put up that beautiful chart earlier that showed you very clearly the risk-return trade-off, that as you move up that curve to look for a higher return, you're typically going to take on higher risk. And property exposure is obviously not without risk. And so here you're looking at returns that are going to be somewhere in the range of 5.5 to 6% over and above the RBA cash rate, which again, our clients seem to resonate with, given that we're in a market where rates are likely as low as they can go, and the only expectation now is that they do move higher. And that obviously means that that target rate of return should move higher when that cash rate does rise. But this sort of investment, very different to the AAM deal, which is an unlisted private equity transaction. This investment is listed on the ASX. It provides monthly distributions, and it typically is going to track around, you're not buying this for capital improvement, so it's going to track around that issue price of around $1.60, which is where this particular deal was. And so again, it provides diversification for clients to get into this private debt sector. They're an experienced manager, and again, stable monthly income and risk-adjusted returns, and our clients really like that. So again, I only had a short time to discuss a few different things today, but I thought those two products give you a really nice insight as to the diversity that you can achieve speaking to our team and being part of the Wholesale Investor Register. And again, we deal with self-directed clients. Obviously, Dion's team is there to provide you with advice. So again, you can access a lot of these opportunities through Dion's team as well. And so just in the interest of time, I might leave it there and then we'll move on to questions. Thank you.
Thanks, Paul. Thanks for demonstrating the depth of the capabilities with private wealth and also the opportunities that we get to share with our self-directed clients. So with a few minutes to spare, we have received a couple of questions through the Q&A. So let's look at those and where we get to. So Sally, a question around, given the overvaluation of markets, what kind of contraction is possible in 2022?
Thanks, Adam. Sounds like I might have to get the crystal ball out for that one. But look, I mean, our base case is that we're not staring down the barrel of a bear market in equities in 2022. And that's why, we continue to recommend to our clients that they run portfolios that have, a pretty decent allocation to growth assets. And so from that perspective, we're not sort of super bearish on equities, but I do think it is important to think about, the environment getting a little bit more difficult as we move through next year, given what we know is going to happen to central bank policy. And let's also remember we are moving further into the expansion. So we've come through the easy part where it's all about recovery and economies do well, markets do well. I think the outlook's going to be, a little bit more difficult than that. So we should be prepared, I think, for periods in markets where, like we saw in September, equities were down sort of 4 or 5% on the month, depending on which index you look at, but then they came back pretty strongly after that. So there will always be corrections. And I guess one interesting sort of piece of work that we did earlier in the year was to have a look at, around recessions. And we did this using US data. And the US have a group that actually date recessions. So they tell you the month that the recession started, the month that it finished. We went back sort of and had a look at the last sort of 5 or 6 recessions in the US, and we looked at how different investment markets behaved around recession. So some markets start to get nervous well ahead of a recession happening, and they typically markets like bond markets or credit markets. But what we found with equity markets is that equity markets do not reach their peak for the cycle until 3 to 4 months before the recession starts. So unless you're really convinced that we're staring down the barrel of another global recession in 2022, our view at Jb Weir would be that, we don't have to get sort of too worried or too concerned about a big correction lower in equity markets. And so for that reason, what kind of contraction is possible? I think you'll have periods where markets are going to be down sort of maybe 5 to 10%, but they will come back after that. And we don't think that, a bear market, which I think some people sort of typically define as a correction of 20% or more, is the likely scenario for equities next year.
When we talk about correction, we're seeing more conversation around gold. How does gold play into the portfolio of an investor?
That's a great question, and one we get a lot from our clients at Jb Weir. So Dion sort of ran through the way we approach asset allocation, which is to look at those 7 asset classes, and we think of them in terms of economic risk, really. So starting off with low risk, like cash and government bonds. And gold we place into a category of assets called uncorrelated assets. And the reason that we call them that is they don't tend to move up and down with the macro cycle. And so for us, when you look at the theory of asset allocation, most of the theory tells you should have a pretty decent allocation to gold in your portfolios. And we do go back to that period in March of 2020. And when you look at how different asset classes performed through that period, gold was actually one of the best asset classes through that nasty correction in equity markets and also in bond markets, which were sort of dysfunctional for a while. Gold tends to move in line with real yields. So as real yields go lower, the gold price tends to go higher. And I guess, you would argue with real yields at very negative levels at the moment, you would sort of say, well, how much more upside is there really for gold? But our view at Jb Weir is the way we've been thinking about gold, we have a small allocation to it in our portfolios. And effectively, we've actually been, hoping for is the right sort of phrase, but we've been looking for a move higher in real yields, which sees the gold price come off a little bit as a good opportunity to actually increase our allocation to gold. So that's the way we're thinking about it at Jb Weir, which is that if we do see gold correct lower, we'd actually use that as a good opportunity to increase our exposure to that. So we are pretty favourably disposed to gold.
Thanks. I think I've got time for one more question, and rightfully so, it should come on the back of the gold question. Crypto. We're seeing investors being able to access crypto or industries around crypto through ETFs. We're seeing financial service providers providing a platform. We're getting commentary from federal government around seriously. Jb Weir's view on crypto as an asset class. Is it an asset class? Thoughts on crypto?
It's a great question. So the way we think of it, and as Dion outlined and I spoke to a little bit, we think of all these things in the context of a multi-asset portfolio. So the first question you have to ask about cryptocurrencies is, what are they? Are they a growth asset? Are they a defensive asset? Are they an uncorrelated asset? And I think the short answer to that is we're not sure, in the sense that when we look at the correlations of, say, Bitcoin, for example, against global equity markets, sovereign bond markets, those correlations tend to change over time. So you'll get a different number if you look back 1 year versus 3 years versus 5 years. And so it's difficult to sort of know where to put cryptocurrencies in the portfolio. So that's the first issue that we face. And then the second issue that we face, I guess, is just, understanding that cryptocurrencies have seriously larger realized volatility than pretty much every other asset class we look at. So we like to think of, equities as a volatile asset class. Well, crypto, is more volatile by a factor of, at least 10 than equities. So the question you have to ask is, by placing an allocation of your capital into cryptocurrencies, into your portfolio, you're exposing your portfolio to more volatility. And the question you have to ask is, do you think you're going to get the return to compensate for that? So, I think the first important thing is to look at cryptocurrency on a risk-adjusted return basis. So what sort of returns are you getting, and do they look so great relative to the underlying risks that you're running in your portfolio? And so when we did some work on this earlier in the year, what we find is it's not clear that adding crypto to a multi-asset portfolio really increases the risk-adjusted returns of the portfolio. Sometimes it does, sometimes it doesn't. And so I guess for those reasons, we didn't see a compelling reason or a justification to jump into that space in an aggressive sort of way. So I guess my sense would be at Jb Weir, we're watching it, we're observing, we're learning, but we're reasonably cautious on cryptocurrencies, and it's sort of yet to in our view, make a really compelling reason as to why we might include it as part of a multi-asset portfolio. I suspect that if we're going to do it, it will fall under uncorrelated assets, and we may have a small exposure to it just to start with. But it's certainly an interesting space. It's an exciting space, but it's also a space that is not without its risks. And I guess the RBA put out quite a significant piece of work on this last week, where one of their senior officials basically sort of said, look, as liquidity starts to get withdrawn from markets, as regulators start to cotton on to what's going on, none of this stuff is sort of overly encouraging for that space. So I think there's a little bit of tussle going on between people who see it as the next internet and perhaps those who tend to fall on the more conservative side of the fence, like central banks and probably Jb Weir, if I'm honest, who are a little bit more, I guess, reserved in their enthusiasm for that space.
Thanks again, Sally. That's right on time, everyone. So firstly, Sally, Dion, Paul, thank you so much for joining me today for this conversation. To our valuable clients, thank you for your time. Really appreciated your attending today. This seminar has been recorded, so if you'd like to revisit, please reach out to your relationship team who extended the invite to you. And also, any further questions you may have, again, please reach out to the relationship team in NAB Private. We'd appreciate being able to connect you with our guest speakers today. And on that, I will say thank you and enjoy the rest of your day. Take care. Bye-bye.